Hello and welcome to this session in which we would look at analytical procedures when it comes to the payroll cycle. Now we have to understand that we got to this point after we have looked at the payroll cycle, introduction to the payroll cycle, and we looked at the internal control and substantive testing. Now in this session, within substantive testing, we could use analytical procedures. And this is what we will focus on in this session. So what is analytical procedures? What exactly are they? I know I keep repeating myself, but think of them as detective work for auditors. What you are looking at is the relationship between different pieces of financial and non-financial data, sometimes within financial data, sometimes financial data and non-financial data. And you're looking for unusual trend or figures or percentages. This could include using ratios, horizontal analysis, vertical analysis. Now, if you don't know what these are, I'm assuming you know what a ratio is, what horizontal, vertical analysis is. If not, you want to go to Farhat lectures, look at the financial statement analysis. But we'll look at some of these examples here, but I'm pretty sure you should be comfortable with these topics. And the goal is to identify what looks out of the ordinary. We want to spot unusual fluctuation, unexpected relationship in account balances or relationship. This is the goal, is to use analytical procedures in the payroll cycle. Now, we need to talk a little bit more about analytical procedures. Why do we use them? Look at some techniques and their benefits. And they're not required in every step. You're going to see when analytical procedures are required and when they are optional. So we will discuss why they are useful in the payroll cycle. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
The first thing I want to do is to make the case that analytical procedures are very useful for the payroll cycle. Why? Because the payroll cycle is very predictive, is often very predictable. Why? Why is the payroll cycle predictable? Because when you want to compute the total expense for the wages, salaries, and commission, well, you know how many employees you have, or you should know how many employees you have. You should know how much each employee makes. Well, if I know how many employees I have, I know how much each employee makes. This makes the predictability element of this cycle pretty straightforward. So the predictability allows us to make accurate estimation. And these estimations make analytical procedures even more reliable when it comes to the payroll cycle. Now, do we have to use analytical procedures? And the answer is depending on which stage of the audit we are working with. I know I'm repeating myself, but it's very important to go back and repeat this. First, we use the analytical procedures as part of the risk assessment. Yes, this is a required step, and this is where we look at analytical procedures and we'll try to figure out which areas are most likely have the problems based on the risk assessment in which we use analytical procedures to pinpoint. It is required. How about during the audit, which we are doing now? During the audit, analytical procedures is an optional step. Based on what? Based on the auditor's judgment. And I just told you, when it comes to payroll, we should take advantage of analytical procedures because it's very predictable. And when things are predictable, it's useful, it's helpful. So you have to ask yourself, are these procedures helpful in this situation? And for the payroll cycle and for example, property, plant, and equipment, they are very, very useful. So the answer is yes. And you need to use analytical procedures at the end of the audit to get the overall pictures of the company's health. You want to ask yourself, now, do things make sense at the end of the procedures? Does everything make sense as a whole? And this is a required step. So at the end of the cycle, you have to use analytical procedures to make sure figures are making sense. You would look at the overall pictures. Now we're going to dive into specific specific analytical procedures as we are going through the audit, during the audit, to help us as a substantive testing. We're going to start by looking at payroll expense and account balances versus the prior year. So what can we do? Well, we can compare current payroll expenses with those from the prior year, comparing this year to last year. Now, what we are assuming here, every time I say we are comparing our figures to the prior year, we assume that the prior year is audited and the prior year figures are reliable. Okay, but this is not a simple comparison as well. We need to consider things like pay increases, changes in the number of employees. So let's look at an example. Let's say last year we had 50 employees. And last year, on average, each employee earned $50,000. This should make the total payroll expense $2.5 million. Well, that's great. If we have the same number of employees and the same average salary, we should have $2.8 million. Now, if I told you the company gave 3% raise, well, 3% raise means you have to increase the average salary to $51,500, new average salary, and recompute your figures. Nevertheless, you could do so. And it's if we take 51,500 times 50 employees, the payroll expense should be 2,575,000 approximately. Again, these are approximate. Now, if we went from 50 to 55 employees, then you have to make an adjustment. If we went from 50 to 45 employees, you have to make an adjustment. If we are paying bonuses, you have to make an adjustment. And I still remember, I know for a fact, one of the simulations, AICPA released simulation, I believe the one for 2024, don't quote me on the year, but I'm pretty sure it's a simulation, whether it's an audit or for, I don't remember, basically gave you a simulations about analytical procedures when it comes to payroll. So it's a very important topic. So we would expect to compare 2,575,000 to the actual payroll expense. And a big difference would raise a flag. If the amount was 2,600,000, well, we can say we are comfortable. If the amount is 2.5 million, we are comfortable. Now, it could be higher or lower. It could be some employees took some days off during the year unpaid, or it could be some employees got overtime or rewards. It could be higher or lower, right? But if the payroll is 2 million, we should be concerned. If the payroll is 3 million, we should be concerned. Concern means we need more work to do. Otherwise, using analytical procedures, we could be comfortable with that. Another tool we can use is direct labor as a percentage of sales. If there's a relationship between labor and sales, then we could look at this. If there's a relationship between direct labor and sales, well, then we could look at this percentage from year to year, and it should be consistent. Now, again, we assume in here there's some sort of consistency. For example, last year labor cost was $1 million and sales were 10 million. And let's assume in the prior 3 years, it's always 10%. We notice that it's direct labor is 10% of sales. Why? Because there's a relationship between sales and labor. In other words, our business for us to make sales, it seems it requires 10% of direct labor. This could be for farming, this could be for manufacturing, because you need direct labor. If that's the case, assuming everything else is equal, nothing have changed, no technology, direct labor as a percentage of sales should be 10%. So we should expect to see the same percentage this year. If it's fluctuating, let's assume this year sales was 15 million. We would expect direct labor to be 1.5 million. If it's something different, we need to ask ourselves why. Were we able to produce with less labor? Or there's something wrong? Or did we change how much we pay the labor? Are we paying them more? Are we paying them less? If it's more or less, those are the questions you need to ask. Another question is commission expense as a percentage of sales. Very similar to direct labor as a percentage of sales. You're looking at some expense that you can connect to sales. And commission is pretty more predictable, especially if your sales ability, if your sales engine, if your marketing is relied on salespeople that you pay them commission. So similar to direct labor, you would compare commission expense as a percentage of sales to the prior year, just to see if there's any consistency. So if commission happens to be 5% of sales last year, we would expect it to be the same unless we decided to pay our commission people more. Let's assume we decided to pay the commission 7%. That we expect to be commission expense as a percentage of sales to be 7%. In case we lowered commission, that's different. In case we change our sales structure, now we are selling more online. We're no longer needing people to sell for us. We would expect commission expense to be lower. Or we are now selling directly, company to consumer. We don't have salespeople. So those are the things you would look at. But if there's any relationship, you want to use that relationship as a predictability item to perform the audit. Another thing you could look at is, this is pretty good, payroll tax as a percentage of salaries. What are we talking about here? The company will have to pay, they have their own payroll tax. And payroll tax, when we say tax, it means we are paying to some sort of a government, whether that government is federal, state, or sometime local for payroll. Why this should be accurate? Because the government, it's going to come after you. Simply put, you have another entity now looking over the figures of that company. So you could rely on the payroll tax and say, okay, the payroll tax as a percentage of salaries should be consistent or should be pretty predictable. So this involves comparing payroll tax expense to total salaries expense. For example, payroll were 100,000 last year for salaries of 1 million. Well, we could say that it seems that payroll tax is approximately 10%, and that's usually the case, between 10 to 15 in the real world. 10 to 15% of the salaries are paid in payroll taxes by the company. Now we compare this figure to this year, again keeping in mind any changes in tax rate. Now if the government raised the payroll tax, then we would expect the 100,000 to be, assuming we still have salaries of 1 million, to be maybe, for example, 120 or 130, depending on the changes in tax rate. And the opposite is true. In some circumstances, the government might lower the tax rate, then you have to make those adjustments. Also, you could compare accrued payroll taxes from year to year. Accrued payroll taxes are the payroll taxes that you accrue, that you record at the end of the period when you have cutoff. There's a cutoff time, December 31st, and at that point you have to accrue payroll taxes, and you would compare that amount from year to year. That amount should be small, nevertheless, you would look at it. And now we're going to talk a little bit more about accrual, because accrual is important. When we talk about accrual, it means we are accruing liabilities. When we are accruing liabilities, our concern is obviously accuracy, that's one. And our concern for liabilities is what? What's the concern for liabilities when it comes to audit? Omitted liabilities. We did not report all the liabilities. So the next thing we're going to look at is, how do we determine from an analytical perspective that we have the proper accrual, the proper liabilities? Let's take a look at this multiple choice question from farhatlectures.com. In evaluating the fairness of the amount accrued for vacation pay, sick pay, and other benefit, the most important consideration is what? What did I tell you when you are looking at figures? What's the most important consideration in your opinion? It should be. Okay, let's take a look at D first. The client is capable of meeting its liabilities as they come due. Well, does this help us with determining what's our accrual? This helps us determining whether we can pay our liabilities or not the fairness of the amount, whether we can pay it or not. The accrual of these liabilities is consistent with that of the preceding year. Is this an important factor? Yes, I would say that's an important factor. Looking at last year and comparing last year to this year, it's a good factor. It's an important consideration. Let's hold on to C. Look at B. The amount paid for the current period are accrued. Well, the amount paid for current period are accrued. Yeah, but that's after the fact. The amount paid for the current period are accrued. It means we already paid them. We're looking at, what do we look at to determine that the amount is fair? We look at the prior period. That's an important consideration. Therefore, between B and C, B is out. A, the preceding year's amount are not included. Yeah, the preceding year amount should be included. The preceding year amount should be included. Therefore, the best answer choice is the accrual of these liabilities is consistent with that of the preceding year. And this is one of the most important consideration in determining the fairness of the amount accrued for those vacation pay, sick pay, and other benefits. Why? As I mentioned in this recording, in this analytical procedures for payroll, analytical procedures for payroll are very predictive. So if last year we had accrual of 50,000 for vacation, sick pay, and other benefits, assuming everything is the same, you can predict the number to be 50,000. Unless you have more employees, less employees, or you change the policy of vacation, sick pay, and other benefits. Otherwise, last year is an important consideration in determining the fairness of this year. Therefore, the answer is C. What should you do now? You want to go to Farhat lectures, look at additional multiple choice, true, false lectures, other consideration to look at whether you are a CPA exam candidate or an accounting student. Invest in yourself. That's the best investment you could make. Good luck and stay safe.